Welcome back to the deep dive. Today, we're really getting into the nuts and bolts of personal finance.
Yeah, we're tackling two huge areas, aren't we? Protection and growth.
Yeah.
Insurance on one side, savings and investments on the other.
Exactly. We're looking at how you secure things and how you build things, financially speaking. Our sources give us a pretty clear map.
That's right. And our goal really is to cut through all the jargon. We want you to understand the bits that matter, the things often hidden in the small print.
Like why you can insure some people but not others.
Or the real impact if you insure your house for the wrong amount. And crucially, how inflation silently eats away at your savings if you're not careful.
Okay, let's dive in, starting with protection. Life cover, the basic idea is simple, isn't it? If someone dies, especially a main earner, there needs to be money.
Money to pay off the mortgage, cover living costs, because state benefits, well, they usually only cover the bare minimum, if that.
But it's not just about needing money. There's a fundamental legal rule here.
Yes, insurable interest. This is key. To take out a policy on someone's life, you must stand to lose out financially, directly, if they die.
And this isn't new, is it? There's some fascinating history here.
There really is. It goes way back to the Life Assurance Act of 1774, nicknamed the Gambling Act.
Gambling Act, why?
Because before that, people were literally taking out insurance policies on strangers' lives, speculating on when they might die. It was, well, pretty morbid gambling. So the act stopped that. It said you need that direct financial interest. It made insurance about covering a loss, not creating a windfall based on, someone else's misfortune, or worse, having an incentive.
Right, got it. So who has this insurable interest today? Yourself, obviously.
Unlimited interest in your own life. And save for your spouse or civil partner. That's clear.
But what about other family? This is where people often get it wrong, isn't it?
Absolutely. The sources are really clear. There is no automatic insurable interest between parents and children in either direction.
So I can't just insure my child's life just in case.
Not unless you can demonstrate a specific, quantifiable financial loss you'd suffer from their death, which is, frankly, very rare for a minor child. It's a huge misconception.
Okay. And what about, say, business situations? Creditors, employers?
It's always limited by the potential financial loss. A lender can insure a borrower, but only up to the amount of the outstanding debt.
Makes sense.
And an employer might insure a key employee, but again, only for the estimated financial value that employee's loss would represent to the business. It's capped.
Right. Okay, let's look at how these life policies are actually set up. Single life is straightforward, but the joint life options, they seem quite distinct.
They really signal the policy's purpose. You've got joint life, first death.
That sounds like the standard one for couples, maybe covering a mortgage.
Exactly. It's usually lower cost. It pays out when the first partner dies and then the policy ends. Simple protection.
But then there's joint life, second death. That sounds specific.
It is. Very specific. Our sources highlight it's used pretty much exclusively for inheritance tax planning.
Why only for that?
Because inheritance tax usually becomes payable only after the second partner in a marriage or civil partnership dies. So this policy is designed to mature at that exact point, providing the cash needed to pay the tax bill without forcing the heirs to sell assets, like the family home.
Ah, clever. Okay, let's clarify something else. The words insurance versus assurance. I always thought they were interchangeable.
They often get used that way. But technically, there's a difference. Insurance covers something that might happen, a risk, like your house burning down. You hope it doesn't. That's term life cover, too. You might outlive the term.
Okay.
Assurance, on the other hand, covers something that is certain to happen eventually.
Yeah.
In this context, that's death itself.
Yeah.
So whole-of-life policies are technically assurance.
Right. So term insurance is for a fixed period, pure protection, no investment frills.
Exactly. It's the cheapest way to get cover for a set number of years. Good for covering liabilities that also have an end date, like a mortgage.
And there are different types. Level term,
where the payout amount stays the same throughout the term. Ideal for, say, an interest-only mortgage, where the debt isn't reducing.
and decreasing term.
The payout amount reduces over time, usually in line with the repayment mortgage balance. Because the potential payout shrinks, the premiums are lower than level term.
Makes sense. And family income benefit, that's a type of decreasing term too.
Yes, but instead of a lump sum, it pays out a regular tax-free income from the point of claim until the end date of the original policy term.
Ah, so it replaces lost earnings directly.
Precisely. It can be a very cost-effective way to provide for dependents' ongoing living costs, rather than giving them a large sum they then need to manage or invest.
Okay, contrasting that with whole of life assurance, this pays out whenever you die, right? No fixed term.
That's the idea, provided you keep paying the premiums, which will be higher. Because it's guaranteed to pay out eventually, it has to build up some value over time.
So it might have an investment element
Mm.
and maybe a surrender value if you stop paying.
Yes, generally. It's more complex, more expensive, really suited for things like leaving a definite legacy or covering that future inheritance tax bill we mentioned. Not usually the best tool for covering a mortgage that'll be paid off for 25 years.
Right, different tools for different jobs. Now, what about protecting against illness, not death? The sources suggest this is actually a bigger risk for many people.
Statistically, yes. You're more likely to have a long period off work due to illness than to die prematurely. And the financial impact can be devastating, arguably worse than death in some cases, because your costs might even increase.
So how do we protect against that? Critical illness cover, CIC.
CIC pays out a tax-free lump sum if you're diagnosed with one of the specific serious conditions listed in the policy, things like cancer, heart attack, stroke.
But there are catches, right?
Oh, definitely.
Yeah.
The key things are the illness must meet the exact definition in the policy wording, which can be very strict. And usually, you have to survive for a minimum period after diagnosis, often 14 or 28 days, before they'll pay out.
Okay, that's for a lump sum on diagnosis. What about replacing your monthly income if you just can't work due to illness or injury?
That's where income protection insurance, or IPI, comes in. Some people might remember it as permanent health insurance, PHI.
Right. And this pays a regular income.
Yes, a regular tax-free income, typically around 50% to 65% of your pre-disability earnings. It pays out after a pre-agreed waiting period called the deferred period.
And the key feature of IPI, what makes it stand out?
It's security. A true IPI policy cannot be canceled by the insurer, no matter how many claims you make, as long as you keep paying your premiums. It pays until you can return to work, or the policy term ends, often retirement age, or death.
That non-cancelable part sounds really important.
It's huge,
Yeah.
especially when you compare it to the alternative, accident, sickness, and unemployment cover, ASU.
Which is often linked to mortgages, mortgage payment protection insurance, MPPI.
Often, yes. ASU is fundamentally different. It's more like general insurance. It's
Yeah.
typically an annually renewable contract.
Meaning the insurer can choose not to renew it, say,
Yeah.
if you've claimed.
Exactly.
Yeah.
Or if they just decide to pull out of that market. And the payout period is usually very limited, typically just 1 or 2 years maximum per claim.
So much less secure than IPI.
Far less secure for long-term issues. ASU is a short-term fix. IPI is designed for potentially long-term, even career-ending disability.
Let's use that Alex and Sarah example from the sources. Couple, mortgage, kids, 3 months sick pay from work. Why wouldn't they just get cheap ASU? Why push for IPI?
Because 3 months sick pay disappears incredibly quickly if you have a serious illness or accident. An advisor would look at the priorities.
Okay, what's first?
First, cover the biggest debt and mortgage. So life cover, maybe with critical illness included. Then protect the dependents, maybe some level term, or that family income benefit we talked about.
What? And then income.
Then income replacement. Given their 3 months sick pay, they could choose an IPI policy with a 13-week deferred period. That waiting time makes the IPI premium significantly cheaper.
Ah, so you align the IPI waiting period with the employer's sick pay.
You can, yes. It makes the IPI more affordable, but you still get that crucial long-term, non-cancelable protection that ASU simply doesn't offer. It guards against the catastrophic scenario.
That makes a lot of sense. Okay, shifting slightly to general insurance buildings, contents, that sort of thing. These are called contracts of indemnity. What does that actually mean for a claim?
It means the aim is to put you back in the same financial position you were in immediately before the loss occurred. No better, no worse. You shouldn't profit from an insurance claim.
So, if my 10-year-old sofa gets ruined by a leak, they won't just give me the money for a brand new top-of-the-range one?
Not necessarily. They might pay the value of a 10-year-old sofa, market value, or repair it, or replace it with a similar new one if the policy has new for old cover, which many contents policies do. For buildings, it's often about reinstatement, rebuilding, or repairing what was there.
Okay. Buildings insurance covers the structure, fixtures, fittings, even sheds and walls, against standard risks like fire, flood, storm.
Yes, the standard perils. But there's a potential trap if the property is left empty.
Ah, the unoccupied clause.
Exactly. If your home is empty for an extended period, often more than 30 or maybe 60 days, cover for certain risks like burst pipes, escape of water, or vandalism might be restricted or completely excluded unless you agreed with the insurer. Very important for holiday homes or if you're between tenants.
Right. And this leads us to probably the biggest gotcha in general insurance, underinsurance.
Oh, the averaging clause. Yes, this catches so many people out, particularly with buildings insurance.
Explain it. How does it work?
Okay, basically, if you insure your property for less than its true rebuilding cost, the insurer assumes you've chosen to bear a proportion of the risk yourself.
So they penalize you on claims.
They reduce the payout on any claim, big or small, by the same proportion that you were underinsured.
Let's use that Harry example. House needs £300,000 to rebuild, but he only insures it for £200,000. That's only 2/3 of the value.
Correct. He's underinsured by 1/3 or covered for 66.67%.
Then he has a small claim, say £1,000 for some roof tiles blown off in a storm. What does the insurer pay?
They don't pay £1,000. They apply the average. They pay 2/3 of the claim. So Harry only gets £667.
Wow. Even on a small claim that's nowhere near the £200,000 he insured for.
Yep. He's penalized because the total sum insured was wrong. It's designed to make sure people insure for the full reinstatement value. Getting that value right is critical.
That is a brutal lesson to learn after a loss. Okay, quickly on content stuff you'd take if you move house. What about covering valuable items taken outside the home?
For that, you typically need to add all risks cover to your contents policy. It usually covers items anywhere in the UK, sometimes worldwide.
Do you have to list every single thing?
Not usually. There's often a limit for unspecified items, maybe £1,500 or £2,000 per item. Things worth more than that, like expensive jewelry, watches, cameras, need to be specified items listed individually with their value.
Got it. Okay, we've covered protection pretty thoroughly. Let's switch to the other side. Growth. Building wealth through savings and investment. Where do we start?
The sources suggest a priority pyramid. First things first, an emergency fund, a rainy day fund and accessible savings for unexpected short-term needs.
Before you even think about long-term investing.
Absolutely. You need that buffer. After that, you save for specific goals, maybe a house deposit, education, retirement.
And when we talk about growth, especially long-term, there's one major hurdle.
Inflation. The silent killer of purchasing power. Your money has to grow just to stand still in terms of what it can actually buy.
So an investment needs to beat inflation to give you a real return.
Exactly. And historically, over the long term, and long term is key here, investments linked to equities, to the stock market, have been the most likely to achieve that real inflation-beating growth.
But for that rainy day fund, you want safety and access, not stock market volatility. So cash accounts, deposit accounts.
Yes. Capital isn't at risk. You can get your money quickly. And there's a crucial safety net.
The FSCS.
The Financial Services Compensation Scheme. It protects your deposits up to £85,000 per person, per authorized firm.
So if I have, say, £100,000 in savings.
You'd need to split it across at least 2 separate, unrelated banking institutions to ensure it's all protected, not just 2 accounts at the same bank.
Good tip. Now what about these structured deposits? They sound a bit more complicated.
They are. They typically promise your initial capital back, so there's that safety element, but the return isn't fixed. It's linked to the performance of something like the FTSE 100 index.
So you get market upside with no downside risk. Sounds too good to be true.
Well, there's usually a catch. You might only get a proportion of the index's rise, not the full amount. And you almost certainly won't get any dividends that the shares within the index paid out. So reduced risk, but often significantly capped reward.
Okay. Moving up the risk-reward ladder slightly. Fixed interest securities. Bonds. Gilts. What are these?
Essentially, you're lending money. With gilts, you're lending to the UK government. With corporate bonds, you're lending to a company.
And you get what back?
You lend for a fixed period. During that time, you receive a fixed interest payment, called the coupon. At the end of the term, you get your original capital back to par value.
Sounds relatively straightforward. But their prices can change in the market based on yield.
Yes, this is where it gets a bit more complex. The coupon interest rate is fixed when the bond is issued. But general interest rates in the wider economy change all the time.
So if I have a bond paying a 5% coupon, and new bonds are now being issued paying 6%.
Nobody wants to pay full price for your 5% bond anymore. For your bond to be attractive, its price has to fall on the market.
Why?
So that the actual return someone gets for the money they invest, now the running yield becomes competitive with that 6% available elsewhere. If they buy your £100 bond for, say, £90, that £5 coupon represents a higher yield on their £90 investment.
So bond prices fall when general interest rates rise.
Exactly. That's their key vulnerability. Even though gilts are considered very safe in terms of getting your money back from the government, their market value can definitely fall if interest rates go up.
And corporate bonds are riskier than gilts.
Yes, because there's the additional risk that the company itself could go bust and default on its payments. So they typically have to offer a higher coupon rate than gilts to compensate investors for that extra risk.
Right, higher potential reward for higher risk. Okay, finally, let's talk about equities, shares.
Right at the top, in terms of potential growth, but also risk. Buying shares means buying actual ownership, a tiny piece of a company.
Which gives you voting rights sometimes, and a claim on profits.
A claim on residual value, if the company is wound up, yes. And potentially dividends payments out of profits. But, crucially, dividends are not guaranteed or obligatory. The company decides whether to pay them.
And unlike bonds, shares don't have an end date. You don't get your money back automatically.
Correct. There's no redemption date. You get your money back by selling your shares to another investor in the market, hopefully for more than you paid.
So the big attraction is capital growth, but the big risk is capital loss.
Precisely. Share prices can be very volatile. You could make significant gains, far more than with bonds or cash, but you could also lose a substantial amount or even all of your investment.
And there's tax to consider.
Yes. If you sell shares for a profit above your annual allowance, that's subject to capital gains tax, and any dividends you receive are subject to income tax, albeit at special dividend rates.
How do investors manage the risk of owning shares?
The absolute #1 principle is diversification. Don't put all your eggs in one basket.
Meaning,
Spread your money across shares in many different companies, in different industries, and ideally in different countries. So if one company or sector does badly, it doesn't wipe out your whole investment.
but diversification can't protect you from everything, can it?
No. It protects against specific risk, one company failing, one sector declining. It cannot protect you against systemic or market risk, like a global recession or a stock market crash where pretty much everything falls together.
So summing up the downsides of shares, risk of losing your money, prices bounce around a lot, and illiquidity.
Yes, sometimes it might be hard to sell your shares quickly at the price you want, especially in smaller companies or during a market panic.
Okay, quite a journey there. Let's try and pull the threads together. What are the absolute must-knows?
Well, on protection. Insurable interest is essential. Remember the Gambling Act. IPI gives long-term, non-cancelable income security in a way ASU just doesn't. And please, please check your building's insurance value to avoid that averaging clause trap.
Definitely underline that one. And on growth.
Cash is safe and accessible, protected by the FSCS up to $85K per institution. Bonds offer fixed income but can lose value if rates rise. And equities. Well, equities offer the best historical chance of beating inflation over the long run, but they come with significant risk and volatility. Diversification is key.
So it leads to a final thought, doesn't it? If we generally accept equities are needed for long-term real growth and cash is vital for emergencies, what about those complex middle ground products like the structured deposits we touched on?
Exactly. They offer that tempting promise of capital protection, guaranteeing your initial stake back. But they often achieve that by severely capping your potential growth, your potential real return.
So the question for you, the listener, to ponder is this. When you're planning long-term, should your absolute priority be minimizing risk, protecting your capital from any nominal loss, even if it means potentially falling behind inflation? Or should the main focus be on maximizing the chance of a real inflation-beating return, accepting the risks that come with investments like equities? Where does that balance lie for you?
A tricky question with no single right answer. Depends entirely on individual circumstances and risk tolerance.
Something to think about. That's all we have time for on this deep dive. We'll see you next time.